The market, welcome back, is above yesterday's high. It's basically made a new high for the day. So that's interesting. And 18,333. The push, I think, is coming from banks. The bank Nifty will come up. And the HDFC twins, HDFC Bank and HDFC, between them are adding about 20 index points to what the Nifty is doing. Actually, it's a combination of banks and IT. So HDFC Bank and ICICI Bank, three of them. And then there is Infosys and TCS. Which is the other leg, which is adding about 15 points or so to the index move that we are seeing. So will this be the push which finally clears the zone? I think we'll have to kind of wait and watch. At the broad level on the upside, I mean, first you've got to stay above this level, the opening level, and then, I mean, 18,400, etc. comes into view. Quess Corp is the next company as promised, which is in focus. Quess Corp, even as the market has done well, relatively and in some senses in an absolute way as well, has not done. The stock Quess Corp is down some 50% this year. The company's job platform, Monster, has transformed to an end-to-end talent management platform, Foundit.in. It will be known as Foundit.in in Asia Pacific and West Asia. To discuss more on this and generally what is business looking like really, Ajit Isaac, chairman of the company, is now joining us to take some questions. Mr. Isaac, great to have you with us here. Thank you very much. Appreciate it. Could you tell us a little bit about this sort of transformation, rebranding? How is this? Why have you done this now? And, how much will this help really? Because, I mean, there is a big gap between the number one player, which is Naukri, and where Monster is at in the same segment that you guys operate in. Take it away, sir.
Sure. So to give you a kind of historical background, we acquired Monster in 2018, and then the first 18 months or so was spent in managing the transition from the previous owners to us and in reorganizing the technology backend. In 2020, we had COVID, and it was in that phase that we hired new leadership. We got new product specialists on board and started drawing the roadmap for a new product journey for Monster, which has now come to the finish point. And we've launched the new product. So the branding itself is to symbolize the new product that we've got, is to bring to the market a differentiated position from what it was in the past, and to give it a new lease of life in the market. We've had some terrific response to the product. Our traffic's gone up. This year, our revenues are expected to go up by about 70% year on year over the previous year. So we're seeing great traction, and we are slowly getting more market share. We're here for the long term. And we think that we will acquire a significant space in the job board market as we move along.
Okay, Mr. Isaac, good morning. I wanted to ask you about your own, way forward in the company, because I understand that you have been buying stake in the open market. What's the reason for that, and how much does it stand at? And would you want to sort of get back to that 55% stake that you had about 2 years ago?
Well, so, we've had two situations since we listed when our stock price fell. One was when COVID happened, and, we dropped, to a low of about 160, and then that was the time when I bought a bit. And even now, I think the fall is unreasonable. It does not really reflect the value of the company, and that's why I've been buying a bit. As a promoter, I'm happy to enhance it as much as I can. And the position of the company in terms of its results for the future, I have a confidence about it. So I think, I will do as much as I can to increase my stake in the company.
At current levels, you're a buyer. At current prices, you're a buyer, sir.
Absolutely, yeah.
Okay. And you don't have any targeted holding as of now, but you're saying that, you believe that the stock price is undervalued, so you look to chip in as and when you can. We get that point. Just to get on to the previous point about Monster's market share, in comparison to Naukri, what is the updated number? If you could just give us a broad sense. And you're saying that there is potential out here, so you must be having a targeted market share number.
So, it's a bit early to work with the market share. I think there are two things happening. One is the market itself is changing a bit because of the slowdown in the IT hiring space. So I think we have to see how that pans out for all the players in the market. Second is, our platform is a little different from what it was in the past. Previously, we had, like our competitors, we had a discover-only platform where you keyed in searches and you got results. This time around, we have more personalization. If you and me search for MBA candidates on our site, it's more likely that we will get slightly differentiated results because of the way the algorithms analyzing who the user is. So we think these are changes that will come to play. We don't have a target right now on the market share, but we are looking at traffic, and that traffic is, we are seeing significant changes in traffic. The last month has been one of the highest increases in traffic for us.
Mr. Isaac, you mentioned 70% growth in revenue year on year. That is for Monster.
Monster, that's right.
For Monster, yeah. Okay. We'll ask you to put out, a guidance for the full company as well, and you're welcome to do that. But just one point, what is the proportion of variable pay versus fixed pay contracts in this part of the business, workforce management?
So our collected pay is close to about 75% today. So only about a quarter of our business is what we upfront pay. So, and in our staffing, in our professional staffing business, it is entirely on a back-to-back contract with our clients, where we pay salaries on the basis of what we've agreed with our clients. So there's no variability in that sense.
So, just to understand the hiring, right? Because there are many other companies that have indicated to us that hiring has slowed down in a big way. Do you expect this slowdown to continue? And if yes, do you think it could put more pressure on not just your overall business, but on your margins as well in the second half of the year?
So that's a good question. IT, I think for the next 2 quarters, is not going to see a turnaround very easily. And from all indications, it's going to stay flat. Having said that, there are certain pockets in IT which are still seeing renewed demand. For example, in areas like DevOps, cybersecurity, in the area of big data and digital processes, we're still seeing a lot of requirements. We're also seeing global development centers that are set up for offshoring of back office process of companies still hiring in India. And that process could pick up through a possible recession in the US, because US companies will want to reduce costs. So I don't expect the IT business to turn around very quickly, but the rest of our business, and IT constitutes, we will do maybe about 50 crores of EBITDA from our IT staffing business out of a total of maybe around 600 odd. So I think it's 10% of our overall numbers. So I'm not unduly worried, because in a 15-year time span, we've seen at least 2 or 3 instances when we've gone through such cyclical movements. And it will settle down another, let's say, 6 months to 8 months time, and then we should ride the upwave again.
The reason I'm also asking is because, some of it is reflecting in your stock price. The stock is down almost 25% in the last 1 month. Of course, that's not for you to assess why it's happening, but there are some concerns, right? And perhaps on operational performance as well. Do you think your margins could get hit further? And if yes, from this 3.2% mark that you hit in Q2, what could be the trajectory in the second half of the year?
So I think our key issue is our IDC. We have to reduce our IDC. Our costs have to come down. We have to reduce by about 20% per month. And that is an exercise that's ongoing right now, one. Second is we have to continue our pace of growth. We've been growing by about 5 to 7% every quarter. And that we have to sustain either by top line growth or by a product mix that's changing that will add more margins to the company. We've come to 3.2. Our first target is to get to about 3.5%. Once we stabilize at 3.5%, then I think we'll go upwards from there. Our stated goal in our company is to look at a 20% ROE. So a margin improvement is important, but even if margins don't expand significantly, if the EBITDA that's reported helps us to get to a 20% ROE, then I think we've reached the greater goal that's there now at Quess.
Mr. Isaac, briefly, by when will Monster turn profitable, sir?
So Monster will need another year to get market share and to turn profitable. I think it will burn some cash next year, but it will exit the next financial year on a cash neutral basis. And then from there onwards, we'll make money.
Good speaking to you, Mr. Isaac. Thanks so much for stopping by. Wish you all the best for the second half of the year, and look forward to chatting up with you maybe in the new year. Well, let's move on then. The next corporate we're speaking to today is Fino Payments Bank. Remember, the stock was buzzing and trade was locked up a circuit, 20%. It's up closer around 10%, I think, even today. Mr. Ketan Merchant, the CFO at Fino Payments, joins us. Hi, Mr. Merchant. Good morning. Thanks so much for speaking to us.